In 2019, the global airline industry brought in roughly $840 billion in revenue. 12 months later, passenger revenue collapsed by over 60%, almost overnight. Now here's the thing. There were people, pension fund managers, intelligence analysts, quantitative strategists running scenario algorithms, who had wargamed a global pandemic years before COVID hit. They didn't predict the exact virus, they didn't know the date, but their models had already mapped what a global health shock would do to travel, supply chains, and consumer behavior. When it arrived, they weren't surprised. They adapted. The rest of the world panicked. That advantage didn't come from a crystal ball. It came from a discipline called Strategic Foresight, a systematic, data-informed way of stress-testing reality before it happens. And today, I'm going to show you exactly how it works and how it can make you a better investor starting now. So let's get one thing straight right away. Strategic foresight is not fortune-telling. It's not some mystical attempt to predict what's going to happen next Tuesday. It's a structured way of asking a better question. What are the different ways the world could change, and what would each of those changes mean for my money? Think of it like this. Before a long road trip, you check the weather. You look at traffic. You make sure your spare tire isn't flat. You're not predicting a breakdown, you're preparing for one. Foresight does the same thing, but for your financial decisions, and it uses 3 core tools. The first is scenario planning, building multiple detailed stories about how the future might unfold. The second is horizon scanning, continuously watching for early signs of change. And the third is weak signal detection, spotting tiny cracks that could become massive shifts. We mapped these tools against how most people actually invest, and a critical gap emerged, one that costs ordinary investors real money every single year. Most investment analysis starts with a reasonable assumption. The future will look something like the recent past. If a company grew its revenue 10% a year for the last 5 years, analysts project 10% next year. If the economy expanded for a decade, models assume it'll keep expanding. This works until it doesn't. And when it breaks badly. In 2007, every major bank's risk models said that a nationwide decline in U.S. housing prices was essentially impossible. Their data went back decades, and it had never happened. So their models said it couldn't. You know what happened next. Foresight doesn't eliminate surprises, but it forces you to ask the question that backward-looking models never ask. What if the rules change? But here's where it gets genuinely powerful for investing. Markets are very good at pricing information that everyone already knows. Great earnings last quarter? Already in the stock price. You're not going to outsmart millions of investors on known information. What markets are terrible at pricing is things that might happen but haven't yet. Possible futures. That's exactly where foresight operates. Here's how it works mechanically. You take the 2 biggest uncertainties that could reshape your investment landscape and you plot them on 2 axes. Let's say one axis is AI regulation, strict on one end, permissive on the other. The second axis is interest rates, high versus low. Those 4 combinations give you 4 different futures. Each one creates different winners and different losers. When you lay your portfolio across that grid, you start to see bets that would pay off enormously under one scenario, but cost you almost nothing under the others. Investors call these asymmetric bets. Limited downside, massive upside. Now, no method is foolproof and timing still matters. But this approach dramatically tilts the odds by forcing you to see opportunities the consensus hasn't priced in. Now you might be thinking, scenarios sound great in theory, but how do you actually spot these shifts before everyone else? That's where weak signals come in. And this might be the most valuable concept in this entire video. A weak signal is a small, easy-to-miss hint that a big change is approaching. Think of it as informational alpha, the same edge quant traders hunt for in price data, but found in research trends, patent filings, and funding patterns instead. Here's a real example, and this one still gets me. In 2017, 8 Google researchers published a paper called "Attention is All You Need" about a new neural network architecture called a transformer. Almost nobody in the investment world noticed. It was an academic paper on archive, irrelevant to next quarter's earnings. 5 years later, that architecture became ChatGPT, and it triggered one of the most dramatic stock market rallies in recent history for companies positioned to benefit. The investors scanning the technology horizon had a 5-year head start. By the time AI hit the cover of every magazine, the biggest gains were already locked in. And you don't need a PhD to do this. Free tools exist right now: Google Scholar Alerts, the Archive Weekly Digest, patent databases, and funding trackers like PitchBook and Crunchbase. Set up 10 minutes of scanning per week, and you're already ahead of 95% of investors. That's the power of treating weak signals as alpha. Not price alpha, information alpha. Quick question for you, and I'm genuinely curious about this. We've covered 3 tools so far: scenario planning, horizon scanning, and weak signal detection. Which one feels most missing from how you invest right now? Drop it in the comments. Whichever one gets the most votes, that's the one I'll deep dive in a full, dedicated video next. Okay, back to it. Here's a question most investors never ask. What am I assuming about the future right now, and what happens if I'm wrong? Every portfolio is built on hidden assumptions. You own bonds? You're assuming inflation won't spike permanently. Heavy in tech? You're assuming regulation won't limit their business models. Invested entirely in one country? You're assuming geopolitical stability. Now, if you've traded for any length of time, you know backtesting, running your strategy against historical data to see how it would have performed. Foresight does something different. Call it pre-testing. Instead of testing your portfolio against what already happened, you test it against multiple futures that haven't happened yet. Here's how I apply this with my own portfolio. I take whatever I'm holding, run it through my 3 active scenarios, and ask, is there a single scenario where more than 40% of my positions get hit simultaneously? If yes, I rebalance before reality forces me to. When you do this, you discover risks that diversification alone doesn't fix, because it's not about owning different stocks. It's about owning assets that behave differently under different futures. Remember that road trip analogy from the beginning? Here's where it really pays off. Most of the financial industry runs on a quarterly treadmill. Analysts focus on next quarter's earnings. Fund managers are judged every 3 months. News cycles measure in days. This creates an enormous opportunity for anyone thinking in years and decades. And this isn't theoretical. Shell, one of the biggest energy companies on Earth, has used scenario planning since the early 1970s. When oil prices collapsed in 1986, most of their competitors were blindsided. Shell had already explored that exact scenario and had contingency plans ready. That foresight practice gave them a structural edge for decades. Demographic shifts, energy transitions, regulatory regime changes. These forces move slowly but redirect trillions in capital. The investor who positions for them early captures value that the quarterly focused market hasn't even begun to price. This is the intersection of macro investing and foresight, and it's where the biggest structural edge lives. So when you connect all of this, one thing becomes clear. The edge in investing isn't predicting the future correctly. It's preparing for multiple futures thoughtfully, and having the tools to recognize which future is unfolding while everyone else is still catching up. Here's the practical takeaway, and you can start this today with 0 cost. Step 1, scan. Pick the forces of change most relevant to your holdings: technology, regulation, demographics. Step 2, map your uncertainties. What's the 1 or 2 things that could split the future into completely different paths? Right now, US-China tech decoupling is a big one. So is the trajectory of AI regulation. Step 3, build 2 or 3 scenarios around those uncertainties. Step 4, Pre-test your portfolio against each scenario. Where are you exposed? Where are you concentrated? Step 5. Set signposts. Specific, observable events that tell you which scenario is becoming more likely. Then revisit in 90 days. That single exercise puts you ahead of the vast majority of investors still making decisions by looking only in the rearview mirror. Here's the thing that surprises most people about foresight. It doesn't make you anxious about the future. It actually makes you calmer. Because instead of being afraid of change, you've already thought about it. You've already pre-tested it. When it arrives, whatever form it takes, you recognize the pattern and you act while everyone else is still processing the shock. The future is not something that happens to you. It's something you prepare for. Don't forget, drop your answer in the comments. Scenarios, scanning, or signals. That vote decides the next deep dive. See you in the next one.